Hi everyone, this is Alok Patnia, Managing Partner and Founder at Taxmantra Global. We are a 15-year plus cross-border global tax and legal firm. We have our offices in 5 countries, which is Singapore, UAE, UK, US, and India. And in the last 15 years, we have helped close to 750 businesses who are disrupting the ecosystem, who are changing the status quo. We have helped businesses from zero to a IPO journey. And we have helped businesses in their taxation, cross-border transfer pricing, CFO advisory, corporate law, fundraising compliances, ESOP structuring. And we have traveled the complete journey with many such businesses, as I said, from zero to IPO days. So today, I've got Somik with me, who is part of my leadership team. And today we will talk about a very, very important aspect in this masterclass, which is alternative options to traditional ESOP plans. We will also talk about employee stock option plans, its impact, taxation, accounting, plus alternative options like phantom stocks. How phantom stocks are helping Indian startups, Indian tech startups, Indian business owners to retain higher quality talent and grow their business. ESOPs really helps businesses to hire and retain top quality talent without much of cash outflow in the initial days. So without further ado, let me ask Somik to start this and a very important masterclass for today.
Thanks, Alok. Is my screen visible?
Yeah. So screen is visible. You can
I am
go
just
to.
doing it full screen. Just a second.
Yeah. It's a very, very important topic which we are talking about today. Yes, Somik, you can start now.
Yeah. Thanks, Alok, for the lovely introduction. So, ladies and gentlemen, what happens nowadays, and we often get to hear about various facets of ESOP implementation. Every week, we sit with the board of the companies, with VCs, and even various tech entrepreneurs in implementing their ESOP plan. Of late, what we are finding is that the traditional ESOP plan have few issues, have few disadvantages, which is getting triggered by many employees, and many employees are taking a not so correct approach while the startups are implementing the ESOP. And over here, phantom stocks becomes very important. Phantom stocks give an alternate solution to the entire scheme of things, and hence it becomes the main important part. So let me start with a case study which I feel very common in the startup ecosystem. Here is a startup company. Of course, it's a company that we have assumed a name, no similarity. It has a reward and retain employment policy, and hence they started an traditional ESOP plan. Our client, which was the company, had an employee, and we are here by assuming the name Arjun Mehta, who was granted ESOP. The 10,000 options were granted, and it was 450 per share. The ESOP was at on the fair market value, 25% over 4 years. They should have been giving to Mr. Mehta, and the grant price is 100 rupees per share. Again, these are assumptions, but this is very common in the startup ecosystem. Now, Arjun decides to exercise the ESOPs for the uninitiated. ESOPs, when you say exercise of options, it means that you say that, boss, you need to give me the ESOP plan. You need to allocate me the shares right now. So this is called ESOP exercise. So exercise price was 100 rupees. He had to pay 100 rupees. He, after 3 years, it was 7,500, 10,000 options. So 7,500 was vested after 3 years. 7,500 into 100, 7,50,000 he had to pay. The fair market value at the time of exercise was 450 per share, and the taxable perquisites standard in totality of 26,25,000. Now, this was a Series B startup, so the exit was quite far. The first problem that the employee faced was the immediate tax burden. There was a cash outflow, and that sort of a thing also create a lot of problem as such. There was tax burden, but there was no liquidity. Just imagine, when it's an unlisted company, it's not a public listed company, even if you pay the money to exercise, to buy the shares, right? You cannot get an easy exit. You have to wait for the listing option. You have to wait if the shares are being acquired by a third party, and only then you have to do. So Mr. Mehta faced a lot of issue over there. And again, this is a company valuation. This valuation is depending on fundraise, right? So tomorrow, if you have a down round, your entire funding, your entire ESOPs get on a toss. It depends on the mutual consent with the investors and the startup founders. So that becomes very important. In a listed company, when you do it, you get an easy sort of a listing, easy valuation, easy reference. What will be the capital gain? What should be the future plan? But in an unlisted company, there are problems, and of course, I mean, everyone over here knows, in terms of ESOPs, there are administrative delays that happens, right? So this is not a one-off problem, ladies and gentlemen. This is a very common problem that people face. In fact, in a survey in 2024, people found out that over 70% of Indian startups that delay ESOP set up plans for phantom stock instead. Now, the reason over here is why they work in India is very simple. Over here, there is no dilution. Cross-border investors, startups, employees can get it, and it's a flexible sort of thing, right? It's not a specific thing that is there. So you get flexibility, and at the same time, there is no dilution, right? Now, what are phantom stocks? For the first people who are hearing it for the first time, phantom stock is a plan wherein an employee gets the benefits, the monetary benefits, without owning any share of the company. Now, how does it work? So when you have gotten these shares, right? If the fair market value of that company was 100 rupees, right? After 3 years, when you plan to exercise it, the fair market value, the last round at which the valuation was done, the fundraise was done, is say 500 rupees, right? Now you get hardcore cash over here. Is 500 minus 100, 400 into number of options. As simple as that, right? So let's assume, in the previous example, if a employee would have gotten this, right? And if there is 10,000 options at the time of when he received this option, it was 100 per share. But then after 3 years, it becomes 450 per share. So 450 minus 100, that is 350, right? Into 7,500, he would have gotten that cash. There would have been no dilution. He would have gotten the cash and given the money as perquisites, and pay the taxes accordingly, right? We will come to the taxes a bit later. So just wanted to confirm that over here in phantom stock, there is no actual transfer of equity. It's more into notional stuff, and the cash settlement is important. You get hardcore cash for the person who works hard for the business, and the person gets the monetary value. There is no monetary filing, ROC filing over here. It cash being gone out, and very importantly, there is no dilution in the company. The founders have the entire shares over here. So it's a win-win situation, ladies and gentlemen. Imagine you're paying off the employees, they are motivated to work hard, and at the same time, you have got no dilution in the company, right? So that is something that is very important. The Companies Act, you have to follow FEMA cross-border, there are to follow. You have to go for Indian Contract Act during the time of this phantom stock drafting, right? You have to have it properly drafted under Indian Contract Act, and then there are board approval. Now, very interestingly, and for the people who is in the cross-border side of the business, right? So many a times the traditional ESOP have a policy that the ESOPs can be implemented only to a full-time employee. So if you say have an advisor, right? You cannot give them ESOPs because at the end of the day, they are advisor, not a full-time employee, and ESOP law bar it, right? But in case of phantom stock, because there is no specific law doing that over there, and hence this becomes very important, very rightful that you can give the monetary worth even to the advisors as well, right? So that is a broad perspective of how phantom stocks work. Now, average phantom stocks payout in India have grown 3.4x from 2020 to 2024, especially in fintech, because fintech is the very, very fast mover of this sort of new age things. And it is very, very likely that more companies will come into phantom stocks as they know the advantages of it. Uh, the employees are taxed over here only as per perquisites. So basically, whatever I get the money, I pay the taxes on it, not any notional thing, not where like in the terms of traditional ESOPs, I do not get the monetary value right now. I might get at a later point of time, but then I have to pay the tax right now. It's not in case. You get the money, you pay the tax. Tax triggers only at the time of payout, not in the time of grant, not in the time of vesting. And employer deduction is allowed. The TDS will be there, but there is no capital gain. And hence you can plan it accordingly. So there are a lot of companies that are coming over here. Of course, there are accounting disclosure that has to be done. Is recognized as compensation expense, fair value is exercised. You have to maintain a valuation memo. The accounting part has to be done properly, and in fact this has been tried and tested. Again, a very an example, but the names have been changed and modified. We have done it for another startup over here. They came to us that many of their employees were not happy over here, and they were facing tremendous of problem from the employee side, because one, they have to go through the administrative issue of allowing allotment that was taking time, and hence there was the employees were getting frustrated, and the retention issue was getting is increased. And then again, when the allotment is happening, the founders' stake are getting diluted again and again, right? So we suggested them to, from now onwards, to restructure it and go for phantom plan. What happened, the moment phantom plan was implemented, and within 1 year period, not only they saw a cleaner cap table, lesser amount of allotment, but their retention rate improved by 35%. Now, why? Because they are getting the money, and hence they are happy with their tax planning. They get the monetary worth, not any flimsy sort of valuation that will happen at a later point of time. So that is the bedrock of the entire system. Now, during the time of implementation, you must take a proper help. And I think Alok can chip in over here. He has few points, I guess. So Alok?
So, Somik, thanks. Just go back to the slide of taxation. And this is very, very impactful. And this is the game changer, basically. So, in traditional ESOPs, what happens is that you actually end up paying taxes on the notional value and without any gains which has come to you in terms of liquidity. So, you actually pay taxes on a gain which has not materialized and which has not got liquidated into your bank account. In phantom stock, the game changer is that you only pay when you actually receive that compensation. And since you do not get any shares as such, what you get is a compensation, a promised compensation on some trigger points happening based on performance, based on how company will grow, and vis-a-vis all those conditions. this is a compensation and it is taxed as salary. So it is taxed as salary and it is added to salary, and this is being, and based on your salary slab, be it 30% or whatever the salary slab would be, you will be taxed on that. One more thing, there is no capital gain as such, which Somik has said, because there is no shares transfer, there is no transfer of asset as such, right? So there is no capital gain, it's just uh, taxed as per the normal slab. And the biggest point, because biggest letdown of traditional ESOPs globally and India, mostly in India, is that they end up paying taxes on notional income. Yeah, Somik. So that was a point which I wanted to bring in. And because of that, there is 3.4x jump in phantom stocks, as reported by Your Story and NASCOM report 2024, because of this reason.
Absolutely, Alok, can't agree more on that. And people should be very aware while they issue phantom stock. It's not that they just see and push it over here. It's very important to draft it properly. As I said, it should have a grant option, proper vesting option, proper payout formula. So when it will happen, when the money will come in, is there any milestone? When the company will achieve a particular turnover, when the company will go for a particular valuation, that is very important. You have to have that sort of things inbuilt in the system. It should address the exits, the dispute, the tax holding, the TDS part carefully, and the valuation part as well. So on a broader level, ladies and gentlemen, if we have to check what is the major difference, right, between ESOPs and phantom stock, right? If in case of traditional ESOP, the employee gets company shares with ownership. Employee becomes a shareholder. In case of phantom stocks, employee get the company shares without the ownership, without being the shareholder, but at the same time getting all the benefits, right? In terms of monetary matters. Whenever there is a growth, you get compensated accordingly. And ESOPs are real equity. Of course, you get regulated, there are regulation, but in phantom stocks there are no equity payout. It's contractual, there is no dilution, and hence for early stage startup is very useful. Now there's a common myths, right? Myth one: phantom stocks don't motivate like equity shares, is a common myth for startup thing. Equity share doesn't matter at the end of the day. The payout, timely payout matters, and phantom stocks motivate them time and again. In fact, as I said in our previous slide, how we saw a growth in the fintech company employee retention by 35%, right? So statistics says a lot, right? And again, many people who doesn't know about phantom stocks think that is only for large corporate houses. It's not for startups. But ladies and gentlemen, again, as per the surveys that I have mentioned, things have improved. It's many startups are now implementing phantom stocks, and that is very crucial. There are lesser amount of compliances, lesser amount of documentation, but it's not that there is no compliance. So there are compliances, there are checks and balances, there are ways that has to be planned, and it also enforces governance control in the company, right? So we actually help many companies in implementing corporate governance, and over there phantom stock is highly appreciated, right? So the implementation roadmap is something like you take a board approval over there, and then you issue an agreement, issue the communication, governance and payout tracking is done properly, policy design is implemented, the vesting triggers then happen, then a valuation baseline setup is done, and then payout takes place, right? So I would love to know from Alok why he feels that it's important for companies to consider phantom stock while implementing their ESOP plan, and how companies to think and consider this phantom stock as an option, as an alternate to traditional ESOPs. Alok, you are on mute.
So there are two main reasons, Somik. One is we completely forgot one point, which is in a traditional ESOP, the traditional ESOP also impacts the cap table of the company. And when it impacts the cap table of the company in the sense that actual shares are being allotted to the employees, lot of approval and lot of paperwork to and fro needs to happen with investors. So just think about a startup which is at Series B or Series C level, where there are 20-30 investors on the board, which are global investors, and suddenly ESOP and there is some changes in the ESOP or reduce someone, there is a lot of paperwork which happens because the cap table is getting impacted. Everyone is getting impacted. In phantom stock, because there is no cap table, there is no actual issuance of shares, the paperwork is much lesser. That's number one, which is very important. And because of this, many of the companies are now considering phantom stock. That's number one. Number two is, as I told earlier also, suppose I am an employee, I get traditional ESOPs. Now, as per laws which stands today, I need to pay taxes on the notional value. For example, today, if even if I get at a reduced face value and at a compared to a valued price, fair price, I still pay a tax on that today when I'm being allotted those shares and when I get those shares. Visa way in a phantom stock, I only pay tax when actually I get the compensation, and there is no concept of capital gain as such. So tax benefit and ease of issuing phantom stock vis-a-vis traditional ESOPs because of the cap table impact. These two things are very important to my mind.
Right. Thanks, Alok. I think we have successfully tried to make people aware of the benefits of phantom stock. As you said rightly, there is less compliance, less dilution, and you also have various facets through which employee can be motivated. So, on this note, if you have any question, you can write to us at team@tmghq.com or call us at the given number. We will be happy to make you a partner, and through which we become as a joint venture partner, through which we will try to help you show the right path in your compliance, in your business structuring, and the overall scheme of things, right? So let's conclude over there. Thank you, ladies and gentlemen, for joining us, and we will soon come up with a new topic, new masterclass, wherein we will try to explain the various factors of the startup ecosystem and compliance around it. Thank you. Bye bye.
Thank you, Somik. Thanks.